Welcome, everybody, to another episode of the Smart Money Circle. I'm your host, Adam Sarhan. With me today is a very special guest, Tim Call, CFA and President at the Capital Management Corporation, who manages under $500 million, or just under $500 million. Tim, thank you very much for being here. Can you please...
Thanks, Adam, for having me.
Oh, pleasure. Can you please begin by letting us know a little about your story, how you got involved in this business, and some background for the audience?
I started with investments rather early. My family would receive annual reports way back when they existed, and I found out pretty early in the third grade to skip the glossy part and go straight for the numbers in the back. And it didn't have anybody to help me or to guide me with how to look at investments and read the financials. But by the fifth grade, I felt like I figured it all out except goodwill and amortization. I thought either I'm not smart enough or this is a game adults created to as a fudge factor. And found out in college accounting that was certainly the case. It's a fudge factor, and I've always been drawn to this industry. It was hard to come out of school and move right into investment research and management. Most of the positions open in the industry are sales related, and I thought I wanted to stay away from that. I've since found out life is somewhat sales related. You have to learn how to speak and communicate and show your value, whether that's internally or externally. But so then I got out of college and was able to find a job with bookkeeping for a large bond portfolio. And after a few years was able to go to get my CFA and MBA and come back out and enter the industry as a stock analyst.
Oh, very
And from there, progressively moving up.
So that's fascinating. You started in the third grade reading annual reports?
Yes, I'm that exciting of a person.
Wow. Now, was that from your parents, I'm assuming, or was it just your own natural, magnetism, or you're drawn to the financial world, or how did that come about?
Well, these reports would come to the house, and no one wanted them, and so they ended up with me.
Oh, perfect.
The family, it was before recycling. The family felt like these were very nice books. Why throw them away? And I was immediately drawn to the glossy pages at the front until I started reading some of the back and realizing the front was just PR, and the back is what really matters. And so that was a great foundation. And when I was going through college, the cash flow statement was mandated. So that was perfect timing to have the accounting courses and the cash flow statement becoming uniform and mandated across the board. And I find that to be a very strong foundation that's needed when assessing investments for the long term.
Oh, wow, that's fantastic. So after you got the job with the bookkeeping, you moved over towards sales/investments. Can you talk a little about what happened then until where you are today and what the Capital Management Corp actually does as far as the different services you currently provide?
Sure. I was an equity analyst and did quite well, moved up over time to director of research. But the firm advertised it was growth at a reasonable price and fundamentally based. But in the late 90s, they were influenced by the market momentum and the desire to not lose accounts to firms that were following the tech cycle a little bit more closely. And so they swayed to a late momentum style. And it's no fun working for a firm as an analyst if that firm doesn't have the same investment style that you have. So I was lucky to get a job outside New York at a trust company, and was promoted there to chief investment officer, and was able to create not only uniformity of the investment department, but then subdivisions of products from the approved list. And that went well until one of the founders died, and the firm, it was obvious the firm was up for sale. And at that point, somebody that I had known years earlier back in Virginia, where I was raised, needed somebody to lead the next generation of their firm. And so I was brought back to Richmond, Virginia, and at Capital Management, where I am now. I've been promoted over time, so I'm president of the firm, and the firm is 100% employee-owned, but I'm the largest shareholder. So I don't think we'll have the same problems as my prior employers. We're not going to change styles, and the firm won't be sold out from underneath us. And so it's, one reason why they recruited me is because I had the same investment style that they did. I was drawing on 1,500 stocks to get an approved list of 40 to 50. At Capital Management, the firm's drawing on roughly 3,000 stocks. When we compared our list of 40 or 50 stocks, they had roughly half of the names perfectly overlapped, and the other half I recognize most of, and vice versa. So it was clearly apparent that we had the same exact investment style, which I'm very happy about, because I believe it strongly that it works over time. There are old quantitative studies saying many of the factors being used work, and so to add logic and experience to that, I think, is value added. So since then, factor funds have become prevalent, and I think they are many of them are based on strong principles. So I think they're a good thing for investors to keep in mind. But on top of that, to be able to have the hand-holding, the experience, wisdom, and insight and memory with different industries and companies and managements, I think is additional value added.
So let me actually segues perfectly my next question. Please explain a little about your investment strategy, but let me just recap for the audience. So your strategy is growth at a reasonable price, or fundamental based. So you're looking for undervalued companies that are exhibiting growth in their earnings and revenue. Is that correct?
Yes, earnings, revenue, and cash generation.
And cash
so
generation.
We want to see
Got it.
The cash flow from operations and the free cash flow both be positive and growing over time, and want to see it be a large number relative to the size of the company. Less than half the companies publicly traded generate cash, right, which is scary to think of, but those companies are desperate. They're desperate to issue new stocks and bonds so they can stay afloat. Wall Street loves that because they get underwriting commissions.
Right.
And so those companies tend to get buy ratings, and the ones we buy tend to have neutral ratings because Wall Street's not making any money off them. They're self-funding companies.
That's fascinating. So just to clarify for the audience, the way that you look at stock selection would be finding stocks that are undervalued, but they exhibit growth in three areas or three factors. Number one would be earnings, two would be revenue, and then three would be cash flow. And then the next level that you look at as well is that you want to make sure it's at a reasonable price, meaning the price of the stock is within reason from a valuation standpoint. Is that correct?
Yes. So you can find great companies, but if you pay too much for them, you might not have a good return. So the entry price and exit price matter a great deal when determining the total return of your investment. And so it's certainly to your advantage to buy companies when they're undervalued. But if you're going to do that, you might as well have those companies have growth characteristics as well, and do fundamental research that makes you believe that the companies will continue to grow in the future.
Yeah, no, I love that. So just to help me understand and just clarify for the audience, when you say, I know value, back in the 90s, it used to be $1 million question. Then the 2000s to 2010, it was $1 billion question. And then after the Great Recession or the '08 financial crisis until now, it's become the $1 trillion question. I know value is very subjective. How do you determine, without giving away secret sauce, of course, but how do you determine if something's undervalued, fairly valued, overvalued? Do you look at standard PE ratios, trailing? Do you look at forward PE ratios? Can you speak a little bit about that so help the audience learn a little bit about how to properly determine the value of a company?
We do believe that PE is a great factor, and when using it, it's helpful to make sure it's GAAP earnings or real reported earnings that you're using, not EBITDA or adjusted pro forma type earnings that some companies provide, in addition to GAAP, generally accepted accounting principle earnings. When doing this, we look forward 5 years. We project what earnings will be 5 years from now, and give the company a valuation multiple relative to the market. So does this company, because of its growth rate or other characteristics and history, deserve a premium multiple to the market, or a discounted, or the same multiple as the market? So once we know the earnings 5 years out and what valuation multiple to give the company, it's just mathematical after that to figure out what the rate of return is over the next 5 years, if you're right. And so we look at that annualized rate of return when ranking the stocks that we find very attractive. So we have around 100 stocks we're extremely interested in, but from that we basically take the top 50 when it comes to our valuation work. So it's different from how some in the industry look at valuation. There's some index funds and others who use price to book as a measure of valuation, and they say if a company has a very high price to book value, which would be the stock price divided by the assets minus liabilities, or the equity of the company, based on the annual report. So anyway, the price divided by the equity of the company. And if that's expensive, if that's very high, then the stock must be a growth stock, and vice versa. If it's a very low price to book, it's a value. We don't think that's a valid way to determine valuation. And it goes back to what I learned in lower school, and that is goodwill and amortization are fungible. And you see that often today, where companies make acquisitions and then within a year or two they write off a good deal of the value of the acquisition they just made. And that messes with the balance sheet of the companies. And so we don't believe you should use the balance sheet as a method of evaluation, but the earnings statement and the cash flow statement. So what will the company generate in earnings and cash flow on a recurring forward basis? And that's the main methodology of our valuation.
I love it.
Rule.
So you look at the earnings.
So you might as well have the best of both worlds. You might as well have the best of all worlds: a great entry valuation and a company that has recurring long-term growth. And on top of that, if you can have good management, defendable niche of business that's growing, market dominance, and that sounds like a great investment to me. So out of thousands of stocks that trade daily in the United States, you should be able to find a nice, healthy number of stocks that fit those characteristics. and that we believe that would make it an extremely attractive portfolio. And so that's what we did. And out of the roughly 50 stocks on our approved list, we can then subdivide those by many different metrics. So if we subdivide by market capitalization, the value of all the stock outstanding for the company, we have a SMID, small and mid-cap product that contains the approved companies, those 50 companies, but the subset of those that have market capitalizations below 10 billion.
Okay.
We can have look at the company's dividend growth rates. So out of the 50 companies, the subset that not only pays dividends but has the dividends grow each year, we can make a portfolio out of those and weight the components of that portfolio by the growth rate of the dividends. We can create just a growth and income portfolio that's based on the yield of the holdings, or just a growth portfolio, which is based on our expected total return of the companies. And it's and the last one we have is our most concentrated portfolio is based on just the core factors, the quantitative factors that we use in screening. So out of the 50 stocks, what are the 12 best ranked on that quantitative system? And that takes out a little bit of emotion at the very end, just picking the quantitatively strongest out of the 50. And so they all have a long examined track record that we're very proud of.
Beautiful. No, it sounds like a fantastic approach. And I love the fact that you use fundamental analysis and valuations differently than most people, where you're not so much looking at the book value, the balance sheet, things that most people look at. You're looking at the GAAP accounting, you're looking at earnings, cash flow, looking for that versus the market, giving it a multiple, and then you've got a 5-year time frame. So it's enough to withstand pullbacks or whatever may happen in between, even bear markets. Most bear markets are 18 months or even 36 months if they're long. So a 5-year time frame is long enough to make it through cycles.
Yes, and it greatly differentiates us from the market, where the average participant is either computer-driven or they're day traders,
Right.
And so there's no long-term outlook, and maybe some of them can be right on a short-term basis. But if everybody else is focused on the short term, then we have less competition, and it makes it so it's a easier job for us.
Yeah, that's actually one of the terms I use is arbitrage, and for listeners, it's just this difference in price. So what you're describing, Tim, sounds like time arbitrage, and you're just using time differently than most people. Is that correct?
Yes. So instead of worrying about $1 change in stock price for the day, whether we get in at the high price for that day or the low price, it doesn't materially affect the 5-year return.
Right.
So let somebody else play the penny game on a daily basis. As long as we get the 5 years right, we can benefit from long-term compounding of strong returns.
Understood.
And that's what our investors love to see.
That's the name of the game for sure. So, Tim, can you talk a little about risk management and how you handle it and what mistakes you see people make with respect to risk?
So, by having a valuation discipline, that lowers the risk dramatically. We also have sell disciplines, which include if we're approaching the price target of a stock, or if the long-term fundamentals of a company are deteriorating, then we would like to sell the company. And then there's another step, which is if the stock's been moving in the wrong direction. So if it reaches certain thresholds in absolute terms or relative to the market, we have to reassess it as if we don't own it. And sometimes that results in a sale. Sometimes that results in our adding to the stock. So those lower risk, but then from a top-down standpoint, we don't want to be all in one sector or segment of the market. So most of our portfolios are spread across 6 to 8 of the 10 economic sectors of the U.S. economy. Most of them have small caps, mid caps, and large caps stocks. And even though all of them traded in the United States, many of them have revenue from different parts of the world. And then when we look at a traditional growth value analysis like Morningstar, where they might use a benchmark that includes price to book or other factors, we see that our portfolio has value stocks, core stocks, and growth stocks as defined by those metrics. So all these show us that we have great diversification. We have tended to always have that, even though it's not a rule that we have to have a certain percentage or an exact range relative to the market in any one segment. And I think that's value added. If one segment of the market's greatly overvalued or has deteriorating fundamentals, you don't have to own it.
Right.
So with an index fund, you have to own everything. And as one component gets more and more expensive, that becomes a larger part of the index. So when you're buying the index, you have to buy more of the expensive stocks and less of the cheap stocks that, as they went down in value, became a smaller part of the index. But you don't have to own the index. When people say, "Oh, we think the index is expensive," it's like, well, you don't have to own that. You don't have to own the market. You can own a small subset of the market that's hand selected, that has characteristics that have tended to work over long periods of time.
That makes perfect sense. So the way you handle risk would be to make sure that the valuations remain intact, number one. Number two, to periodically check on the stock to make sure that the performance is in line with expectations and also relative to the market. And then you can determine whether or not you're going to buy more or sell. And then the third thing, if I understand you correctly, is by making sure your portfolio is diversified. And the way you do that is by looking at different sectors, looking at different market cap of stocks, looking at companies that generate revenue from all over the world, not just one country, and then looking at value, core, and growth as well. This way you're properly diversified. Is that correct as far as an assessment?
Yes. Yes.
Perfect.
And in that way, you keep a broad view. And so you don't miss any, you're less likely to miss any huge trends. For example, technology continues to evolve and change, and it changes industries and fundamental dynamics, and it also creates new industries and markets.
Right.
And so by looking at all those different segments, such as traditional growth and value, large cap and small cap, and different industries and economic sectors, you're more likely to see those trends as they're emerging. And I think that's helpful.
I love that. And then when you see those trends emerging, do you just pile into it, or do you, since you see it early, do you allocate adjust accordingly, or how does that work?
We like to see a history first for the industry or the individual companies. So we don't tend to buy IPOs.
Okay.
But once the company's been out for a couple of years, it's built a history both before it became public and while it was public. And we can, we believe, better assess its underlying growth rate and the forward growth rate of earnings and cash flow. And so we don't have to be first. And people feel like they miss some great investments by not being first. They say, "Oh, what if we had bought Google when or Apple when?" they don't remember the stocks that went the other way.
Right.
So
Absolutely.
back in
Great point.
1999,
Yep.
yeah, everything was exciting that was technology or mega cap, but
Right.
but you have to remember with the mega caps, you had Enron and MCI,
Right.
which basically went into non-existence within 2 or 3 years, and you had hundreds, if not thousands, of technology companies that just were not around a few years later.
Right.
So it was easier to buy a basket of these and have a negative return over a very long period of time. And that gets back to the characteristics of the market, where the more expensive stocks might not have as good of a future return, and of course the companies with negative earnings and negative cash generation, they shouldn't, on average, have a strong of a return in the future. But that's where the excitement is, and that's what's being sold. And so you have to get your heads above the clouds and look for what's actually happening versus what is just exciting at that moment. And it's rather hard to do because you're separating emotions from boring homework, basically.
No, absolutely. Absolutely. I'm very big on psychology, and I have a book coming out, Psychological Analysis, in addition to fundamental and technical analysis, this whole other school of thought that most people don't even focus on, which is their psychology and the market psychology. So I definitely understand what you're saying there with respect to the emotions.
It's emotions can be an investor's worst enemy, and there's so many ways emotions can be a hindrance. So your book will probably be rather thick, and so that's the biggest enemy. The greatest friend of an investor is long-term compounding.
Right.
And yet most investors aren't focused on long-term compounding. They're focused on shorter time periods.
Right.
But if you can just put your emotions a little bit to the side and persevere long term, if you're right about the long term, then you should have compounded at a very attractive rate, and that can be quite rewarding. Growing at 7% for 10 years would double your portfolio, and growing at 10% for 7 years would double your portfolio. Of course, the 100-year average for the market is roughly 10%. Doubling every 7 years is very powerful, especially if you're young.
Extremely powerful. Let me ask you the next question I have for you. So what is some timeless advice that you'd like to share that you would have liked to learn in your 20s, or when you got started in the business, or even 30s, or when younger people can learn, or even older people? But what is some timeless advice that just applies, that you see could greatly help investors, in addition to the compounding results, or even speak about that more, whatever it is that you'd like to share?
Well, to use your common sense. So keep it simple. Use your common sense, and don't get wrapped up with the excitement of the day. And I think when you look at the great investors of the past and present, you'll see that is somewhat of an approach they take. They want to make sure they understand their investments, that their investments make a lot of sense, and that they have strong long-term outlooks. So that is very important. Another item related to that is have disciplines that you're going to strictly adhere to over time. And those disciplines can basically be some common sense rules. And so if valuation or growth or cash generation are part of your discipline, then try to never stray from those, because when you switch styles, it usually doesn't end well. And so chasing the herd because your style is out of favor short term it can be very painful. If your approach is soundly based and has worked long term in the past, then you're probably better off strictly adhering to it, even when it's out of favor.
That's great advice. Just avoid style drift. In other words, don't drift from style to style,
Yes.
or just chase the next hot shiny object and the next shiny investment system du jour or whatever it is.
It's so easy to drop your investment disciplines when they're not in favor.
Right.
It's frustrating. It's like Chinese torture to have your system be out of favor for not only months but years.
It really is. It's so true.
Right. But there are multi-year cycles in the market. So there's growth versus value, small cap versus large cap, dividend payers versus non-dividend payers, and they go in and out of favor. And you can be in subcomponents that outperform long term, and a mix of characteristics that greatly outperforms long term. But they can also all be out of style for short periods of time. And when you're in one of those, you just have to remember that 2 or 3 years is really a short period of time when you're looking at your investment horizon. And one way we show that to clients is you can put up a graph of the market of the last 30, 50, or 100 years and say, look at that blip. That was the October crash of 1987, or that was the tech crisis. So on a long-term basis, they become less important, and what really pays off is the long-term compounding.
Right.
And style drift will get you in trouble there. There's some in-house studies by mutual fund companies, some of the largest mutual fund companies, that show that their investors, their mutual fund holders, do worse than the category of mutual funds or that company's category. And it's because the investors keep making changes between the mutual funds.
Oh, that's a very good point. So it's not so much that the manager is shifting the style, it's that the investors are selling the fund when it's out underperforming, buying the hot fund, and then that underperforms, and they jump back into the other fund, and they keep paying up, and they just keep missing it. So the investors are the ones that are doing the style drift, not so much the manager of the fund.
Yes, so I call that late momentum investing. It's after something's worked for a period of time and is about to rotate out of cycle. That's when it looks the best from a price momentum standpoint, and that's when you have the majority of people buying. Most people buy at the top. That's why the top exists. That's when more people are buying than selling. That's why the top is a high price, and almost no one's buying at the bottom. That's the low price.
Right.
And so after something's worked for a long period of time, if it's on a cycle of some sort, it might be ready to go out of cycle. And in which case, investors who are just finding the space because it's worked so well, I say it's just easier if I put my money there. They're buying at highs, and likewise, as it rotates out of favor and doesn't work for 3 or 5 years, the investors can't take it anymore, and they sell, and that's probably the wrong time again. Those those people are just using natural human emotion. We have a few clients who, of course, have those emotions, but act on those. And so while we manage the client's money, sometimes at extreme points of the market, specific clients call up and ask us or demand that we make a change,
right,
to buy something we don't own, or vice versa. And internally we can name those clients, and some of them have a history of asking or demanding to go in or out of an investment, a category, or the market overall within days of the peak or trough. And of course, they are doing the wrong thing. They're going in at the top or
Right.
out at the bottom.
Right.
So it's our job as their manager to talk them out of it, or to try to have them make a smaller move in that direction.
Right.
But they're their own worst enemy, and I think that pertains to the average investor, and it's because of the emotions, which you'll highlight in your book. It's so hard to keep those clients. They're frustrating clients, but those are the ones you want to keep because they're almost a perfect contrarian indicator.
Yes.
So they're quite valuable.
Absolutely. Now,
So
yeah, go ahead.
that's all. I'm sorry.
No, sorry, I was going to just say, Tim, that's a really, really, really good point. And to be able to identify that is one thing. To be able to understand their contrarian indicators is another thing. And then to be able to act in the opposite direction is a whole nother thing altogether. So you're bringing up a lot of really, really good points. And it's universal. I mean, this happens in everybody's book of business with clients. It's not just your book. We see this, it's universal almost. Human nature never changes, right?
Yes, and it even happens with institutional money, with the boards, with some management companies, with the consultants. They're humans,
right?
And so many of them have normal human emotions, and maybe they're thinking about keeping their job for another 3 months rather than thinking about what's best for the next 10 years.
Right. So that's exactly it. So just the human. I always like to say, if you look at asset bubbles going back to the tulips, or even before then or after, or even till now, it doesn't matter. .com bubble, real estate bubble, credit bubble, it doesn't make a difference. The assets change, the people change, the centuries change, but the one constant is human nature, right? Fear and greed never go away. So that's kind of
right.
Exactly your point. Yeah, no, I like that a lot. So that's great timeless advice. That's great investment mistakes. Now, if you find yourself as an investor making zigging when you should be zagging, so to speak, and zagging when you should be zigging, or making those mistakes, how do you avoid, or how do you avoid making that mistake?
Well, if you're not good at something, and if you're making those mistakes, you're underperforming the market. So
right.
You're not necessarily a good investor. If you're not good at something, then it's great to outsource to someone who is.
Right.
And so we all do that. Great managers do that. You have to learn to delegate and to outsource. That way you can stick with what you do best, or what is most rewarding to you. And the other items can be done by other people who enjoy that work, and hopefully are very good at that work. And so outsourcing makes a lot of sense. And when doing that, it does help to look at audited or examined results of those who you're interviewing. So I'm on an investment committee for a large nonprofit. We had 8 or 9 groups come in through RFP to proposing to manage some of the money of the foundation.
Right.
Only one of the 9 had an audited track record of performance.
Wow.
And it was a good track record. It's just unbelievable what the others were presenting, but then also how not everybody on these committees sees how apparent it is that there's no real track record. So it's scary to know that most people can be sold on those front glossy pages,
right,
rather than the important stuff, all the detail on the rough papers in the back. So if if you have a great salesman, they can sell you anything. You don't want to be sold goods.
Right.
You want to be a buyer.
Right.
You want to buy great investments. So you can search out and hire, just like you're buying. You can hire investors with strong track records, long histories of track records, and to make sure that they're valid is to see audited or examined track records. Or in the case of mutual funds, look at mutual funds that have been around a very long period of time and have track records. The trick there is to make sure you're looking at a mutual fund family that doesn't constantly create and merge mutual funds. So if you have 100 mutual funds outstanding and 50 do well and 50 do badly in 1 year, and you merge the 50 bad ones into the 50 good ones, all you have is 50 good track records then.
Right.
And of course, you go out and create 50 new funds,
And then
so you have 100 funds again.
Right, exactly.
Have a great track record, and you're selling all this stuff. So that's not the track record we're looking for. But if you find a firm with a bunch of mutual funds that does not play that game,
right,
and has a great track record, and there are only a few of those, then you can buy and hold an assortment of their funds. Similarly, if you find individual managers who are like that, then that I believe is the best you can hope for. That's just terrific to find somebody with a great long-term track record, a proven discipline that they will adhere to in the future, and a person you can trust. That way you can worry about other things in your life.
No, that's great advice. And actually, Warren Buffett, I think, is the one who says it, where he's like, find your core competency or stay in your lane. So that's great advice. If you don't have that skill, just find someone who does, and make sure that you do your due diligence when you hire them. And that's great advice as far as overcoming that mistake and being aware of the fact that you're not skilled at that specific, task of investing and or trading or whatever the goal is.
Exactly.
Yeah. So, okay, that's fantastic. Next question I have for you, Tim, is what is the best advice you've ever given or received?
Well, it's a little bit bigger picture than what we've been discussing, and that is you only go around once, and so there are two pieces of advice from that. One is to try to be as happy as possible. Try to enjoy what you're doing. Don't waste your one and only life doing work that's not rewarding, that you hate, and makes you unhappy. The other avenue it can go in is you only live once, so make it happen. And you can say, again, from a happiness standpoint, you're making it happen, but also achieve what you can do. You push yourself, and so if your goal is to help others or to grow something or to build something, go ahead and do it, and take those risks. You don't want to wake up 50 years later and have a life of regrets that you didn't seize the moment.
I love that. That's really, really good advice. So is there anything I didn't ask, Tim, that you want to add?
Well, I think you hit on so much with your experience. You know what to ask. When looking at investments, though, I would just like to summarize that. I do think it's important to make sure that the disciplines you're using work long term, and if you're not going to be the investor, hire an investor that has those disciplines that work long term, that has a proven track record that's been verified by others old to manage your money, they might not be there for you in 10 or 20 years. Make sure you're hiring a firm that has a track record that will continue to be around. So either they're 100% employee owned, they have low turnover of personnel, they have staggered ages.
Yeah.
So they're still around after a cold winter. And you want that. And with many of our clients, they're approaching or entering retirement. And I remind them that with their investment advisors, that they want the same thing that they should be looking for in their doctor's offices and lawyers' offices. And that is make sure everybody's not your age.
Right.
And make sure you have layers of younger people there.
Yeah.
Because if all your trustees or all your doctors are your age, then what are you going to do when you're 75?
Right.
We had one client who was getting frail, and he was very happy with who he had as trustees. And so we said, well, could you let us know? Could you review who they are? And he did, and one of them had already died.
Oh, wow.
And the two others he hadn't talked to for a while, and they were his age. And that's not a good situation.
Right.
So anyway, when looking at a firm that you want to entrust with your money, take a step back and make sure it's on a firm foundation, will be there in the future, will not change stripes, and do that in general when making big decisions in any area of your life.
No, that's great advice. It's almost like you're diversifying the portfolio, diversify your management of your future, so to speak, from the money management to the trustees to the accountants to the doctors to everything, a full 360 view, if you will.
Right. You want to make sure there are backups in place.
Yes.
With each of those prongs.
Yep.
So make sure they're younger people who are drinking the same Kool-Aid at each of those firms.
Right.
So you'll have consistency, because your portfolio manager might take a vacation or might go out of service, just like your doctor might. And you want to make sure that there's someone right behind them that knows exactly what's going on, that can continue the track record and continue your good health, whether it's your financial health or your physical health. That's what's important. That's why you've hired this firm in the first place. So you want to make sure the system's in place so that will continue.
Oh, that's fantastic. And in closing, Tim, what is the best way for people to get in touch with you?
Well, our phone number is readily available, 804-270-4000. And during business hours, somebody will always pick up the phone. So no phone loops. And we're able to do that because we have a high minimum threshold. So we only look at relationships that are $1 million or greater. And that way we can get to know the client and have them grow over time in the exact ways they should. So we get to learn their unique preferences and needs and risk tolerances. And that helps a great deal when managing their money. And my advice for people who don't have net worths of $1 million or more is to find mutual funds that have great long-term track records from companies that are rather consistent. And that can include companies like, or fund families like the American funds. Or you can look at factor funds that have factors that have worked very well in the past over very long periods of time. So that could be like a wisdom tree, would have a lot of factor funds. And when you find one, put money in it and let it compound. And if it's out of favor for 2 or 3 years, try not to worry about it. And one way to do that is put a little bit different style of that fund company. That way, chances are something will be in favor that you own, and you won't be so upset and so apt to move when part of your money isn't working as well for you as the other parts.
Understood. So that's really good advice as well. So the phone number you gave us, do you want to give us a website as well in case people want to reach you online?
Sure. It's CMC VA.com.
Beautiful.
Let me double check that real quick.
Sure.
I don't happen to go to our website that often.
No problem.
But anyway.
I have CMCA.
Anyway.
Yep.
VA.com. CMCVA.com. So that's Capital Management Corporation, and we're in Virginia, so it's CMCVA.com.
Beautiful.
And on there you'll see our team, our newsletters, and it is, again, just highlights our approach, which we've discussed today. But the firm's been around for over 50 years, is 100% employee owned. We think we have a system in place to maintain that. And we have staggered ages. And we really love what we're doing.
Beautiful.
So we have fun at work, and we're fiduciaries on every single account that we manage, meaning we have to act in the client's best interest. And I never really thought too much about that 20 or 30 years ago. I just thought that was automatic. But that's a big point, and that's something people should look for in their manager. You want a fiduciary. You don't want somebody who doesn't follow those standards.
I love it. It's music to my ears. Well, Tim, thank you very much for being on the show, and hopefully we'll speak again soon.
Thank you, Adam.
Thank you. Bye-bye.
Bye-bye.